Hi there, I'm Darren McDermott and you're watching Dukascopy TV for another market update with Ron William. Well, we're going to have a look at the S&P 500 today, gold and of course market volatility. Ron, welcome.
Hi there, pleasure to be back.
So first of all, let's have a look at the S&P 500. Now it has been testing new highs recently, but are there some risks and could we see it enter the more bearish zone?
Well, certainly the new highs that we've been hitting have been positive for short-term traders and pundits out there that are looking at this as a leading indication for positive recovery. But many people who are looking at this from a big picture perspective recognize that this is still that historically extreme 5-year recovery from the 2009 bottom. And so although we're still positive, we are still churning within this sideways, almost topping pattern. And we've been doing this for several months now. Now, from a cycle perspective, which is something I focus on quite specifically, there is a cycle window basically during this month, over the next few days, and later on into the summer Q2 period, which suggests growing downside risk generally on the S&P 500 and on other overextended markets. And so we can just see here that there are some previous cycle overlays that I've put. You can just see the color overlays, overlay A and B. The last time we saw that this cycle hit was roughly 5% correction, and then we saw a similar move on cycle B. Now we've had two interesting time windows here, early May and towards the end of May that we're just approaching now, which suggests that we might get further downside pressure. The key levels to watch for are 1840, 1820, 1800. These are short-term levels, which are also confirmed by the statistical measure at the left. These are just value zones in the chart. And then the big moves are these levels here, 1770, 1730, and 1690. Add them all up together and it equals roughly up to a 10% downside risk on the S&P 500.
Okay, and moving on to market volatility. Now, in terms of market volatility, Ron, if you look at the last few years, we are actually at a very low level, historic volatility lows at the moment, despite the fact we hear about volatility all the time in the markets. But if we look here, you can see the huge difference. Now, is there a big risk that we could actually see volatility head back higher?
Well, this is the other side of the story, and it's very counterintuitive at the moment, and has been for some time, that despite this very overextended market that we're in, the volatility measures, VIX being one of the key measures, is now back at historical lows, which basically means that investors and traders are feeling the most comfortable they felt in a long time. Now, from a technical perspective, we always believe that market dynamics usually play out in duality, in a two-sided coin scenario. So if we see very low volatility right here, right now, the expectation is that we might see the opposite of that coming ahead, so increased volatility. And we can see here two things that are important to highlight. First thing is that during the summer period, volatility tends to spike on a historical basis, and you can just see here that history shows this. In 2010, during the second quarter of that year, we had a spike in volatility. 2011, 2012, and then we had a relatively smaller spike in volatility during last year, during the second quarter. Now, what's happened during this entire period for the last 2 years, volatility has been compressed in this sideways range. Now, this is what's actually more specific to the character of volatility at the moment, that if we actually finally get this potential mean reversion set up to the upside at some point in time, potentially now during the next few weeks into the summer period, then the key technical picture to watch for is this potential breakout of this range, this 2-year compression range, and the trigger level on that is 22%, which is just the most major high there on the range. And if we do get a confirmation above 22%, that would suggest a big upside risk on volatility, and of course markets that are related to this.
Okay, and moving now on to gold. Gold is always an incredibly popular topic. We always love talking about gold. But are we seeing a recovery? Because it has been in the bearish zone recently, but are we starting to see some sort of recovery a little bit?
A little bit. I mean, year to date, it has been up quite a bit on a short-term basis, $100+, which for gold has been a very welcome respite from very oversold conditions. And let's rewind and remember that gold for about 2 years has been down 30%. So it's been one of the most unloved markets out there by a lot of investors and traders, unfortunately. And that old kind of belief that gold is a great safe haven investment during uncertain times, we've had plenty of uncertainty over the last few months, and yet gold has been sideways. So other safe haven assets have benefited from some of those flows over gold. But in my opinion, that technically and also in terms of just macro drivers, gold is likely to have upside respite. In addition to what we've already seen so far. At the moment, it's still within a sideways range, but what I've done is overlaid this geometric trend structure. Sounds a little bit technical, but basically it's just a way of measuring the previous trend and projecting from that. And we can see here, this range here nicely encapsulates the market move. And we need to break above 1400 and 1430, the August 2013 peak, to confirm any type of real upside move. Then we have other levels, 1465, 1555, 90, which is a trading zone, and then finally 1640, and that's the headline here that I've put on gold's short-term recovery favoring the PHI target, the Fibonacci target of 1640. Now, on the momentum studies down below, it's something that I'd like to highlight to the audience. This is a great way of confirming price action or sometimes getting a leading indication on price. So here we have price going sideways. It's maybe not giving us too much of a clear signal, but if we look at the actual technical indicator, we can see that the technical indicator, the RSI indicator, is making new highs. It's at the moment it's flattened out a little bit, but most recently it's made new highs, and so that in just general technical know-how is positive, and we can see here that it's been a positive cycle since earlier this year, flipping from this bearish cycle here. So you can see the red for the bearish cycle, green for the bullish cycle. So that suggests that we might also see further upside on gold.
Very good. Thank you very much, Ron.
Thank you very much.
And thank you for watching Dukascopy TV. Now, Ron will be back again next week, so make sure you tune back then. But in the meantime, also have a look at our Dukascopy interviews. See you soon.